It is the day financial markets should be paying special attention to statements made by one of the largest central banks in the world. Welcome to Almus Market Mornings, your daily dose of global financial updates. There are multiple scenarios which can possibly occur as the world pays attention to what Powell has to say regarding the ongoing rate hikes. Is market going to perceive the statements as hawkish, dovish, or would the statement be in lines with what markets are expecting? All these scenarios affect asset classes very differently. For us in India, it is even more significant as tomorrow we also have the RBI's off-cycle MPC meeting. Can an aggressive Fed speech trigger some kind of interest rate play? Let's find out. JK, going into the FOMC, I would like to understand from you the various scenarios that can play out and what should our listeners be expecting from the markets?
Good morning, Swaraj. Yes, it's a very important day. In fact, two important days in the Indian financial markets. Today's FOMC meet outcome and tomorrow's RBI meeting outcome as well. Clearly, the focus yesterday was on the economic data, actually important numbers ahead of the looming decision by Powell. September JOLTS data, which was a jolt out of the blue, as job openings soared to 10.71 million from 10.28 million, well above 9.75 million expected. And the quits rate was unchanged at 2.7%, illustrating along with the openings, the labor market remains historically tight. And we all know that a strong labor market is something that Fed keeps in mind to assess resilience of the economy to higher rates. Further, the Institute of Supply Management Survey of Manufacturing showed the index falling less than expected at 50.2, which is still in expansion mode, with new orders and employment recording gains. Only the prices paid component was sharply down at 46.6 from 51.7 last month. Expectation was for a reading of 52.5. So there's no concern there. So we have had a very volatile day as far as the currencies are concerned. In fact, in the Asian market, it was the turn of Chinese, economy to trigger volatility after UK and Japan that we had seen in the recent weeks. The risk assets rallied, lifted by rumors that China was looking at phasing out its zero COVID policy, only for the authorities to later deny the speculation. And the sentiment was then dented by the good US economic data, which I just cited, likely forcing Fed to remain hawkish. It also saw a big up and move down in the yuan, which the rupee followed closely. Euro and GBP had a up and down volatility again, reacting to the news from US economy as well as the Chinese news. Rupee had quite a bit of demand as players actually adopted a caution call ahead of Fed meet, but it was well met by the PSU bank selling. Let me say this, that the local players are very well aware that even a slide in DXY does not threaten USD firmness without a change in our own fundamental challenges being improved, and are prepared for the worst case scenario of Fed remaining hawkish. Now the market players actually sit on their hands, clearly focusing on the central bank's future action. So actually, it's not just the Fed. Even ACB was on the focus. I mean, the Australian Central Bank was on the focus again, hiking only 0.25%, which is again cementing some analysts' view that the central banks are slowing their approach. Then we had the UK markets containing stability, with BOE kicked off quantitative tightening program, successfully selling 750 million of gilts back to the market, which is a remarkable turnaround after last month's turmoil in the market, which saw it buying back gilts during a period of turmoil. And the bank is looking to actively sell about 40 million of gilts back to the market. And that's a very positive, evolution of the UK market in the last 1.5 months. Then we also had the ECB, president talking. See, after ECB meeting, the market perceived their statement as a dovish signal. But Lagarde said in an interview on Tuesday that the central bank must keep raising rates to fight off inflation, even if the probability of Eurozone recession has increased. Now to the Fed. US Central Bank is seen announcing its fourth straight 75 basis points hike, which is unprecedented. in the era of announced rate targets. Unfortunately, we won't get an updated summary of economic projections along with the announcements. So we'll be left to speculate on how the participants' subsequent policy expectations have changed. While some deteriorating economic activity, particularly those which we saw last week, have led market to speculate about a potential near-term Fed pivot. Some hard data and rebounds in the inflation expectations have suggested that there is a considerably more to be done on the inflation front. So the Fed's language is down to how the committee sees the economy reacting to rate hikes so far, and whether they consider it prudent to wait its showing up before deciding the quantum of future rate hikes. If the Fed adopts a middle course stating that their future actions will be data dependent, that will be quite neutral to the market. And I personally lean on such a statement. The Fed futures market has priced in a 57% probability of 0.5% hike in December. And this is down from 70% chances, which was seen last Friday. Analyst expectations have a wide range of a no change in language to the other extreme of announcing a pause. So as I said, I lean on a statement on the future moves of rates being dependent on data, and this will be definitely slightly neutral to positive for the risk assets. All in all, we should expect a quiet day ahead of the Fed, not too much of a data also expected. Just on the sidelines, a few positive developments in the global market. The FTSE Russell World Government Bond Index included the New Zealand bonds in the index, and we saw a good inflow of about 2 billion into New Zealand bond market. So possibly some sections of the market saying this is the opportune time to include more global bonds into their index. And also on the gold, we had the World Gold Council report, which says that the demand side is improving for gold, both on the consumption as well as on the central bank side. In fact, the price actions in the gold in the last couple of sessions shows good stability and a bit of tendency to move up. Definitely, gold is also going to take cues from the Fed, but looks like a bottom for gold is not too far. Thank you.
Thank you, JK. And action-packed day yesterday. Of course, we had the important numbers from US regarding the job openings and the labor market, which continues to be strong. So these are some data points which the Fed would be paying close attention to. And for this meeting, of course, a 75 basis is expected. And for the next meeting, the Fed fund futures, they are pricing in a 50 basis hike for the next meeting. While on the domestic front, USD INR continued to be in demand yesterday, which was of course being met by the central bank. And globally, we also saw the Australian central bank hike rates only by 25 basis, somewhat cementing the market's view that the tightening cycle is slowing. As we have kept saying, it's an event-filled week, and today's FOMC would be occurring after markets in India close. So there is significant overnight risk, adding to which we have the RBI's meeting tomorrow. So it's imperative that a good risk management framework is followed. That's it for today. We'll bring you all the latest updates again tomorrow morning. Thank you.
Swaraj, tomorrow's RBI meeting will be followed a few hours later by Bank of England meeting also.
Yes, yes.
Yeah.
That's another avenue where risk is added.
Yes, yes.
So that's it from us today. Thank you so much for listening.